University of Edinburgh Business School presents Blockchain the Future. In the era of technological development, astonishing innovation keeps reshaping our world. Crowdfunding, P2P payments, long-term stock markets and other are changing the landscape of the financial market. But most would agree that blockchain is the most influential one. Some calls it the most important innovation since the internet itself. So, what is blockchain? What are its potentials and challenges? Let's start with Mark's story. Everything starts with baby Mark. Looking at this little baby, Mark's mom is worried about the food safety every day, but blockchain is here to help. Mark's mom can use her smartphone to check everything she wants to know about food for their origins, supply chain, and even current prices. Every information is recorded and transferred via blockchain immediately, so she no longer needs to worry about food safety for her baby Mark. Time flies and baby Mark becomes a high school student. He is going to Japan as an exchange student for a whole year. While he is excited, he realizes that some fees, including tuition and rent, needs to be paid on the first day of his arrival, and only local credit cards are accepted. Previously, intermediaries charged high costs for international transfers, and the process always took several days. But some banks told Mark that they have adopted a new technology called blockchain, so money can be transferred directly with a low handling fee and within only several minutes. Now see who's going to enjoy his life in Tokyo. During his undergraduate, Mark is underfunded because his family is addicted to speculations in the stock market and they failed. So his family want to apply for a mortgage loan. However, traditionally mortgages have some inefficiencies. Every time when a payment is made, this transaction has to be confirmed manually. It is too slow and costly with multiple documentation processes. Now, the commercial banks can use the blockchain to address this issue. At start, blockchain can help establish more accurate record-keeping of Mark's family financial situation. Smart contracts would speed up settlement flows and confirmation. In the mortgage servicing process, blockchain can track the movement of payments easily. And finally, it can provide transparency about agreements and contracts in the secondary market. After graduation, Mark meets a lovely girl called Charlotte and falls in love with her. After a couple of months, Mark is ready to propose. While he holding a diamond ring in front of his girlfriend, the police suddenly shows up and arrests Mark. When he bought the ring, Mark did not utilize the blockchain to trace its origin and got an illegal one. If he used the technology, he would have figured that out. Blockchain can give a passport to each diamond, record its provenance, travel, and transaction. And smart contracts based on distributed ledger can be tracked and used to verify business relationships and agreements. This is also how the police found Mark. Due to this ridiculous episode, Mark fails to make his proposal. Now, let's see how is Mark doing after several years from this incident. At the age of 35, Mark has been working in Nasdaq for some time and is satisfied with the job. Today, however, bad news came.
Mark, as you know, we have fully implemented the blockchain technology, and we just don't need so many employees now.
So you're saying...
Yes, you are fired.
After the shock, he is desperate to sell some investments for liquidity as he does not have much savings. Ironically, with blockchain technology, he received payments within an hour. As an investor, he has an account on the platform which adopts blockchain technology. There are two keys for the account. One is private key and one is public key. When his order was matched, the counterparty would authorize the payment by inputting his private key. Content will be encrypted by this private key. This is called digital sign transaction and it will be broadcasted to the network. The computers in the network are called nodes. They will use this public key to decrypt the message and verify the identity of the account holder. Then it will be grouped with the transactions verified at the same time. These DST will form a block. For a block to be connected to a blockchain, Nodes will solve a cryptographic hash functions. Once the process is completed, the transaction will be executed. As a distressed investor, Mark is eager to ensure the safety of the transaction. Solving hash functions is a messy work. It requires computers to find the original number that, after inputting into the hash function, would generate a defined result. The only way to solve this is trial and error, which requires substantial computing power. It can't be done by one single node, but with plenty of computers. Solving the function typically takes 10 minutes only. The network recognizes only the longest blockchain. For an attacker to succeed, he has to solve at least 2 hash functions quicker than the rest of the computers. Unless he owns more than half of the nodes in the network, this is mission impossible. Since it is a distributed ledger, Mark does not have to worry about the breakdown of some computers in the exchange. His transaction will be executed as usual. He does not have to worry about counterparty risk, as the buyer is not able to undo the payment, and of course, blockchain satisfies his need for cash in no time with low cost. After settling the transaction, Mark starts packing his personal belongings. When he packs, memories flash. He still remembers how everyone got excited when they first tried blockchain on Nasdaq private market, when the first deal was completed on the platform. He even prepared a comprehensive report on the influence of blockchain technology on trades. This report was planned to be presented in a conference next month. Parties meet on a trading platform where they agree on a transaction through a smart contract. But what is a smart contract? Let us zoom in. When parties are matched, codes are uploaded into a ledger to check whether the contract conditions are actually accepted. If they are, then they become immutable and ready for the next step. Now, since we understand what a smart contract is, let's get back to the trading process. After verifying the smart contract conditions, the payments and exchange of assets in various ledgers will be executed automatically. So, how can blockchain change the trading process? Investors can input their private key to verify their identity and holdings. With the verification, investors can reveal their selected data. For instance, identity, assets to counterparty before trades as approved, and therefore reduce the counterparty risk. During the trades, blockchain provides secure, real-time transaction and immediate, irrevocable settlements. Auto delivery and payments of different parties can be done on a cash ledger. The system will report transactions automatically so that the market authorities have more accessible data and transparent supervision. In other words, the market can achieve higher anti-money laundering standards. For the post-trade settlements, no more central clearing will be needed as everything happens at real time. Since the settlement time changes from T+3 to T+ minutes, risks are lowered, which in turn reduces the margins requirement. With the existence of smart contracts, financial products can be executed automatically. Now, let's take a deeper look on how blockchain will change things for investors. With blockchain, both parties will benefit from real-time transaction by reducing the settlement period to T+ minutes. Also, investors now can transact more among themselves since there is a guaranteed execution on open markets. Nevertheless, reduction in costs can be another major benefit. Some institutions will actually need less human capital, while others can have a more specific cost reduction. Buy-side investors, for example, can reduce the dealing and securities servicing cost. Now, let's look at the other side of the story. What are the challenges? Innovation and implementation of a new technology involve high costs and long time. Is it worth to do so? To adopt the technology in the capital market, much larger data sets and high security standards are required to handle the transaction. So far, the computing power's capabilities are still in doubt. It is impossible to eliminate technical failure because blockchain is a new technology and the operational risk is still unpredictable. It is questioned whether it can be recovered quickly if technical failure occurs. Stakeholders cannot prepare for it at current stage. Okay, so now let's dig deeper into the blockchain challenges. Cultural adoption is one of the main challenges. Blockchain is a shift from a decentralized network that requires the buy-in of its users and operators. What about the regulator? Is it the central bank, or the capital market authority, or maybe a new entity? Banks' liquidity is another concern. Let's take a closer look. The real-time transaction will require high reserves since the transaction is settled within minutes. The bank needs to meet the withdrawals requirements as they need to balance deposits with withdrawals. Looks easy, but a challenge for the bank is to meet the central bank requirement like Basel III and keep that balance. The banks can be segmented into three types: the over-liquid bank, where deposits are much higher than withdrawals and can't grow clients' market share; an illiquid bank that can't meet withdrawals requirements or give loans to clients; and the healthy liquid bank that's actually capable of balancing withdrawals and deposits while growing an acceptable client loans account. As a result, small banks will suffer and face two options: merging with bigger and stronger banks, or become a low-quality bank and suffer from being illiquid and low client market share and maybe default. Okay, so now we can zoom out. Mark's report was interesting, wasn't it? Now let's see what do practitioners think.
Is the blockchain technology going to be fundamental to reducing frictions? I think the answer is overwhelmingly likely that it's going to be yes.
The blockchain could disrupt everything. And I pause here to emphasize the last word, everything, because this is going to impact any business or any person that uses database technology and the internet.
Blockchain is never meant to secure against stealing your private key or this type of things.
Blockchain can end up doing a lot more good than bad. It can help solve crime, and it can help stop fraud.
Global banks spend between 30 to 40% of their entire operating costs on KYC, so know your customer and anti-money laundering compliance. That's probably, again, underestimated. So 40% of your entire costs come in just maintaining something like that. So what happens if you are a business and suddenly 40% of your cost disappears? Well, great, you have more money for investment, you have more money for innovation, you have more money to pay back your shareholders, etc.
So, are you ready now to decide whether we have all what we need to use blockchain?